ETFs, or exchange-traded funds, are now a global market of almost $1.5 trillion US. At their simplest, ETFs are designed to track an index. They do it by owning a selection of stocks or commodities in the index that they are tracking. But as our next guest says, not all ETFs are created equal. Some synthetic ETFs can be a much riskier business. Jim Ross from State Street Global Advisors devised the flagship Australian ETF fund, which this year marks 10 years of trading on the ASX. Well, Jim Ross, I guess I should say happy anniversary and thanks for joining us.
No, thank you very much for having me. We're very excited.
One of the things that makes ETFs attractive at the moment is how they perform in volatile markets. Can you explain why?
You know, I think the ETF itself will perform in its market based on the underlying index. And I think the key for the investors, really, it gives them the opportunity to diversify their portfolio across an index or a bunch of indexes and allows them to really kind of control their outcome.
Of course, we've now moved from physical ETFs to synthetic ETFs. I think about half the ETFs in Europe are now synthetics. Why might these be more attractive?
You know, I think it's a really just giving the investors some additional choice. And especially in Europe, where they have complex tax regimes across countries, sometimes the synthetic ETFs allow for an outcome that it can be sometimes more difficult to do in a physically backed ETF, just because of tax withholding, things like that.
But they're much more complicated, or can be, can't they? They're essentially a swap attached to the ETF.
Yeah, they are basically, the basis of a synthetic ETF in Europe is that they are really a swap that's giving you the exposure to an index versus a physical ETF, which is the ETF we have here in Australia, and frankly all of SSGA's ETFs around the globe are 100% physical. But the swap-based ETF is just a little bit different in that it gets the exposure through the swap, and it really gets to the point where the investor themselves needs to make sure they understand that difference and really understand the education piece of that. And where the
that's crucial, and in particular, I guess, the counterparty risk, because you're only as safe as that counterparty risk is.
Well, you're safe as that counterparty risk, and in the European case, those swaps are collateralized, so you're safe as that counterparty risk and the underlying collateral that goes along with that swap. So
some people see you as the godfather of ETFs. Others would say you've got a lot to answer for. The UBS scandal recently, which saw a rogue trader manage to lose, $2.3 billion for the bank, did it through the Delta One desk with ETFs. What do you think happened?
You know, it's hard to get an actual full understanding of what happened. I think the challenge there is the word ETFs is involved, which I think is, you know, rogue trader in certain circumstances when the right risk controls aren't in place can do things and cause risk, and the underlying vehicle they're using is almost irrelevant to that conversation. I think the challenge there for us is his title was Delta One and ETF trader. It could have easily been Delta One and futures trader, and we wouldn't be having this conversation. But ETF is a
relatively new product, and it can be very complex. And I'll just quote from Forbes last month's an article that says, "What has happened in the ETF world in recent years has some uncanny echoes of what took place with collateralized debt products in the last decade. Being sold as transparent both to clients and senior bankers, ETF safety could be as deceiving as a AAA credit rating on a residential mortgage-backed security." Do you see that?
I don't. I've heard that analysis. I've been working with ETFs for 19 years. I think the challenge to the marketplace is as the ETF business has grown, they've gotten more complex, but the underlying pinnings of the ETF, especially the physically backed ETFs, is that they are fully collateralized. So collateralized debt obligations were not fully collateralized.
We in Australia have one of the strongest regulatory regimes on ETFs. We've also got just the simplest of products, really. Some would say, let's leave it like that. Do you want to make ETFs in Australia more complex?
I do not want to make them more complex. I do want to, over time, offer the Australian investor more choice, because I think today with the ETFs in Australia, they are somewhat limited. But I think we can do that in the very strong regulatory environment that's here in Australia in a very appropriate way.
How do you see growth happening in Australia? Because it's been astronomical to date.
It's been a very good, strong growth market, but I actually think it's just really hitting phase one. It has a higher potential for opportunity for growth than most other ETF markets in the world today.
Why do you say that?
Because I think the investor base is ready for it. Some of the product characteristics of low cost, fully transparent. I know There's questions about transparency, but you can literally look every day at the underlying of these ETFs and see what's in them.
You actually mentioned transparency there. The world leader in ETFs, BlackRock's iShares, is calling for a more transparent and uniform level of regulation in the global ETF industry. Do you agree with that?
I don't necessarily disagree with it. I think there's some challenges to how you get to that on a global regulatory basis, where every country has their own specific rules around regulation. I think anything you can do to help the investor can better understand whether it's ETFs or other products available to them in the marketplace, to better understand and educate them on that point is something that's a very, very positive thing for the marketplace.
Jim Ross, thank you very much for coming in.
Thank you for having me.